Grow an actively managed portfolio of gold, silver, platinum, palladium, and rhodium with Auctus Metals today.
What we're going to see next year, and it's absolutely plain, is you're going to see the bubble bursting and faith in fiat currencies diminishing. This is not an investment story. This is a protection story. Now, it's not a question of trying to accumulate wealth. It's a question of protecting wealth. That is the key to understanding what is going on and how you should react.
Hello again, everyone, and welcome to another edition of the Auctus Edge, where we look to give an edge to precious metals investors. Alasdair Macleod, stockbroker, banker, economist, and now author of the Substack at Macleod Finance, where he educates in the value of investing in sound money, joins us today. Alasdair, welcome, and how are you doing?
I'm fine, thank you very much indeed, Patrick. Thank you for having me.
Glad to have you on. It's been a while. Good to see you again. Many things going on. At the top of the list, I'm going to say liquidity, where we saw the reverse repo markets winding down, tightening, and then recently we saw the Fed injecting over 29 billion into the banking system through the repo market, and now we see it up to, I believe, 125 billion in 5 days or so. Alasdair, what's happening here?
Well, basically, it was a combination of two things which have brought on a liquidity squeeze, if you like. The first is that the Fed was quantitative tightening. That was continuing, and that was taking credit out of the system. And the second thing is that the government shutdown basically meant that T-bills, the sale of T-bills was basically accumulating in the general account, which effectively was taking credit out of circulation. So it was the combination of those two things that led to a spike in the repo rate. It wasn't that serious, but you could see that the Fed was being forced to change its objective from trying to control inflation, trying to get the inflation rate down by maintaining interest rates up, to ensuring there's sufficient liquidity in the system, basically, by stopping QT and introducing QE, because QE basically expands the amount of credit in the system. So there's a complete turnaround, if you like, in the Fed's policy. And a lot of that is why gold has really performed so well in recent weeks. I know there's been a bit of a reaction recently, but you can see how reaction looks like it's over and we're going up again. Put another way, it's the market's vote on the dollar, which is going down under this change of policy regime.
Yeah, well, definitely I'll touch on that in just a bit. Because what had happened was that I had seen all over social media that, the liquidity is drying up, the banks are in trouble, this and that. So I thought I'd ask you, in your view, what is the state of the banking system?
Well, the banking system is sort of okay. I'm looking at the American banking system. We'll concentrate on that because that's the most important one. Basically, they haven't really been lending to, if you like, non-financial private sector borrowers that much. Their lending in the private sector has been rarely angled at financial markets and consumers. So really what they're doing is they're promoting asset inflation and they're promoting consumer-driven price inflation. So, there's been no way that there's been an increase in credit aimed at production. I think this is terribly important to understand. So the idea that inflation is going to go away, you can forget it. And on top of that, we've got Trump's tariffs. Now, the apologists for President Trump say, well, look, everybody was saying that it's inflationary, and where's the inflation? But the fact of the matter is that it takes time for the consequences of higher tariffs to work through. And my goodness, they will work through. So that's, so in general, I don't think the problem is so much in the banking system. There is no doubt, however, that so long as rates are if you like, being kept up. That zombie corporations who took out debt needlessly, when interest rates were zero bound, are now having to refinance because this is 5 years later, and a lot of refinancing is ahead, and that is going to hurt these businesses hugely. And I think there's potentially some huge liquidity problems, if you like, in the industrial sector. So that, I think, is the overall situation. But of course, the problem as far as banks are concerned is that having puffed up the financial bubble, particularly equities, that bubble will pop. And when it pops, then there's going to be trouble. So at the moment, banks are not in trouble, but when it does pop, they will be in trouble. And the Fed will do everything it can to keep the bubble going. It will try and, it'll rescue anything, basically, which is large. I mean, smaller and medium-sized businesses haven't got a hope in this environment. But the larger ones will be rescued. And of course, the way they do that is by debasing the dollar. And it's just smelling the air, really, what gold is doing, if you like. That's really why gold not only has risen so sharply in recent months, but is likely to continue to do so.
Yeah, see what you mean. We'll touch on that shortly also. You mentioned inflation. It's still sticking. Possibly, I think a lot of people are thinking that it's going to return. It's going to go back up. Should it start to go back up, what are we going to see as far as monetary policy or fiscal policy?
Well, I mean, the problem here is that not only will inflation go up, but it's likely to go up considerably. Because, I mean, I think, sort of Keynesians and monetarists who sort of look at statistics to try and judge how these things are likely to progress have got the wrong end of the stick. This is human action. And what we're going to see next year, and it's absolutely plain, is you're going to see the bubble, the bubble bursting, and faith, if you like, in fiat currencies diminishing. We're coming to the end of the fiat currency era. And on that basis, what they call inflation is going to soar, and it's going to soar far higher than anybody thinks. Really, what it's reflecting, what it will reflect, is a falling purchasing power for the currency. And the currency will be debased by the central banks. I mean, they've got really no alternative but to do that, because the priority nowadays for governments basically is to manage crises. It's to manage economic outcomes. It's to rescue every business, which carries votes or potentially can carry votes. So the entire banking system, the entire sort of, if you like, system of zombie companies, of which there are so many, they've all got to be rescued. And of course, it's an international problem as well. So, the Fed can probably look after its own patch by killing the dollar, but that doesn't stop systemic risk coming in from elsewhere. And the systemic risk, it seems to me, can come in from two sources. The one is that other banks failing, rather like Credit Anstalt did in 1932, which created a banking crisis, if you like, another additional banking crisis to the one that they already had globally and also in America. And I think, I just cannot see how the Fed can prevent this. The other problem is of course, problems in the derivative sector. I mean, what we are seeing basically is, derivatives in precious metals have lost, if you like, the pricing power to control the value of the underlying metal, which has been the system deliberately, really, since the 1980s. That is going now. And so we are going to be seeing, I think, a collapse, if you like, in the precious metals derivatives system. And that'll spread into other things like other commodities, energy, other metals like copper and so on. So this is this is a very interesting time, if you like. So those two things, I think, you've got systemic risk globally within the banking system. And I mean, to some extent, other jurisdictions, G7 jurisdictions, or even jurisdictions which are not in the G7, if they're tempted to bail in as opposed to bail out a bank, then they're going to create an awful mess. I mean, that could be a real crisis. So we've got very difficult times ahead, Patrick, and I think it would be very foolish to ignore them.
Yeah, completely agree with what you just said there. You mentioned how we may be coming to the end of the fiat system. Gold derivatives pretty much are going to all get in trouble. Um, but where do we go from there after that fiat system? Are we really looking at going back to a physical precious metals backing?
Well, eventually, yes. I think, you're in Singapore, so you're probably closer to the real story than we are. But it is clear that China is preparing herself to protect the yuan against a Western fiat currency collapse. This is why it has opened vaults in Hong Kong and also opening vaults in Riyadh, in Saudi Arabia, and will also have gold to yuan exchange facilities throughout the ASEAN trading bloc, also BRICS, and also the Shanghai Cooperation Organization. In other words, China is preparing itself to back the yuan with gold, at least for trade settlement purposes. I don't think they would extend this to citizens, as was the case under the British gold standard in the 19th century. I think they're looking at a sort of, if you like, a modified Bretton Woods system centering on the yuan. And that's the way they're going. The only thing we don't know is that roughly what the exchange rate will be. At the moment, it was floating, but it will be fixed. It will be fixed because the dollar's purchasing power over the next 18 months to 2 years, I think, is going to change radically in a downward direction. And the same for all the other currencies that are tied to the dollar. So G7 is not looking good at all. It really isn't. All those currencies are looking very, very vulnerable to what's ahead in 2026 and 2027.
Yeah, I'll touch on these precious metals prices. The outlook is positive, without a doubt. Everyone should be looking at precious metals. It should be on everyone's radar right now. Recently, though, we did have a fair pullback on gold, silver, and platinum. What do you attribute this pullback to? Was it just let's say profit taking, or something else going on?
Well, there's a bit of profit taking, but not hugely. It had got to the point, I think, where the shorts, the establishment shorts, bullion bank trading desks, and so on and so forth, could see that the markets were vulnerable to a shakeout. So they shook it out. And, amongst my Substack subscribers, I know of some who were shaken out, despite me saying, look, for goodness sake, don't trade this because you'll get slaughtered. Just stack. And, I'm glad to say the vast majority of them do that. But one or two of them on the edge have really got caught. And I don't know when they'll get back in because they're thinking like investors. This is not an investment story. This is a protection story. It's not a question of trying to, accumulate wealth. It's a question of protecting wealth. That is the key to understanding really what is going on and and how you should react to what is going on. Protect wealth, and protecting wealth basically means getting into real money and getting out of credit. Just get out of credit as much as you can. The ups and downs in the market then become completely irrelevant. That's the way to look at it. But it was interesting that this shakeout has actually occurred at a time when gold and silver were not overbought at all. If you look at indicators like mechanical indicators like the relative strength indicators, then it was overbought. But, if you look at actually what was happening in the market, like open interest in these contracts, the open interest was sort of slightly below the average, which tells us that speculative activity is not that great. So the shakeout wasn't going to really shake out an awful lot of stale bulls, or bulls, if you like. That just didn't happen at all. I mean, it's interesting that the first sign of metals recovering from this sudden shakeout, you've got people getting back on board quite quickly in COMEX. I mean, the open interest in COMEX yesterday on provisional figures jumped something like, 12, 15,000 contracts. So you can see that there's an awful lot of people thinking, oh, we made a mistake. if you see what I mean. This is not an overbought market. It is a market which has been rising on the establishment being squeezed all of a sudden, because nobody really in the investment management field has actually owns gold or silver. I mean, the level of exposure, just looking at ETFs and making a few assumptions about bullion, level of exposure is about 0.5% of all portfolios. This is not excessive. But the problem in terms of liquidity is that people are beginning to realize that the performance of gold and silver is knocking the Magnificent Seven tech stocks into a cocked hat. They're in the wrong things. So they're going to have to move out of those stocks into gold and silver, just purely, on demand for performance basis. But the problem there is to increase average exposure by 1%, only 1% in gold, involves the purchase of 25,000 tons. So how does this get resolved? The answer is it only gets resolved at far, far higher prices. Now, that's an investment management analysis. It actually backs up the correct analysis, which is very, very different. And that is, it is the value of fiat currencies coming to a conclusion, an end. We're looking at the end of the fiat currency system, and their values will decline until such time as the central banks who issue these currencies actually take the means to secure the value of these currencies. Now, what that basically means is you've got to tie it to gold. There's no other option. But, if you look at the American situation, they've spent the last 54 years denying that gold is part of the monetary system and that it has been replaced by the dollar. They are all intellectuals, sort of macroeconomic, Keynesian or monetarist intellectuals who actually don't understand economics in the classical sense, which is the only sense that really matters. And so, how does the whole system, if you like, which is based on fallacy, turn around? It's not going to turn around quickly. And of course, the problem is that, when you got a fiat currency, things are driven by politics. And when they get driven by politics, effectively, central bankers are powerless to take the right action. They're not getting the right advice from all the PhDs they employ. And not only that, but they wouldn't be allowed to take the right actions by their lords and masters, who, I know all this stuff about central banks being independent, don't believe it. At the end of the day, they are political appointees, and their lords and masters are the politicians. And the politicians basically cannot step in and sort things out. I mean, the only way they do that is basically when their currencies lose all their value. And so what's that mean? It means that, the dollar goes down to zero. It's, there could come a point along there where, there's enough of a mandate from the public for President Trump, if he's still in office, to actually authorize the correct action to fix the value of the dollar to gold. to turn things around. But the man's a spendthrift. He's got to turn around completely. And he's not a person who accepts blame for things easily. He's not a man who says, oh, I got it wrong. We have got to get this right. No, he's a man who basically, like Captain Carpenter in the poem by, I can't remember who it was, an American poet, you just battle on until he's dead. I mean, and so we can begin to sympathize, if you like, with Rudolf Hammerstein, who was the head of the Reichsbank in Germany in the early 1920s. There is no option. There is no option. So we know where this is going. You just got to look and understand. That's where we're going. It's the end of the fiat currency system. The end of the fiat currency system basically tells us that it ends with fiat currencies being completely worthless. It's a process that can be stopped, but I just cannot see that there is the political will, the political mandate, and the intellectual understanding of the advisors to actually stop it. So I assume it's going down to zero until I know otherwise.
Yeah, we're even seeing this leaching over into the resource sector, where I believe China says it's going to limit the exports of silver. And I believe there's some 18 LBMA refineries in China, the most in the world. And then we have the U.S. Saying that silver is now officially on the strategic critical minerals list. So what do you see going on with silver now?
Well, wake up, I think is the answer. I mean, the Silver Institute's sort of estimates of supply and demand have had silver in deficit really for the last 5 or 6 years. The balance is always made up by drawing down on investment. Now, define investment. Well, let's not go there, but you can see that, basically, the supply and demand situation is only balanced by being managed. And it has been managed by China over a long period of time. But as you point out, the silver is now effectively going out of China, and China is trying to put a stop to it. The level of stocks in the Shanghai Futures Exchange are now perilously close to 600 tons, which is seen as the minimum liquidity to back that market. So, it doesn't surprise me at all. Silver, I think, with this squeeze, has the potential to go far, far higher. And also from an investment point of view, horrid word investment, or phrase investment point of view, I think people who feel that they've missed the gold run, as it were, are going to see silver as the cheaper alternative to getting in. Now, that's just a purely emotional argument, but I think people will adopt that argument. And so if you look at the London vaulting situation, most of the silver held in London vaults is actually ETF silver. So if you get an increase in demand for ETFs, then the liquidity just disappears completely. And this is why the spot market has been at a premium, in other words, in a backwardation, compared with the futures on COMEX. I haven't looked at it this morning. I mean, the backwardation has gone down, but it still persists. So, this tells us there's no silver around. There's no liquidity. And under those circumstances, where is it going to come from? I mean, you can see that industrial users begin to wake up and think, oh, my God, we've got to pay a lot more for our silver. Even if we don't pay it, we're not going to let any go. I mean, we just got to hang on to it. So I think that's really driving it. And also the other thing, of course, is if you look at the major refiners, they're very, very busy with gold. I mean, they really are. So silver is almost a sort of, secondary issue as far as they're concerned. And that doesn't help either.
Alasdair, with silver, the demand outpacing supply, and then we also have AI, where it looks to use a lot of platinum with this new hydrogen, let's just say economy, green economies, things like that. Either way, there's going to be more silver, more platinum for industrial use that's going to come in. And we've seen gold up some 50% or so year to date. Silver is right about 70, platinum's in the 70% up year to date. You think these two metals may continue to outpace gold simply because of now that industrial use, which is really starting to move pretty heavy?
Yeah. I think the first thing I would say is that gold, if you like, leads commodities in terms of their direction. So what we have now, if you look at a basket of metals priced in gold, that basket is now ultra cheap because gold is anticipating the falling purchasing power in the dollar. Okay, so those metals will catch up. That's the first thing I'd say. The second thing I would say is that we're so focused on G7, on America, Europe, Britain, Australia, and all the rest of it. We forget that 70% of the world is actually in the Chinese and Russian sphere of influence. Shanghai Cooperation Organization, BRICS, and so on and so forth. And if you look at the Chinese economy in purchasing power parity terms, it's bigger than America by a long way. So, there is a world out there which is insulated from our problems. China and Russia, between them, but particularly China, has for a long time been creating its own markets away from dependency on the West. It's invested in infrastructure, whether it's railways, shipping, ports, so on and so forth. The whole, and also technology. They are way, way ahead of us. There is a world there. We've got two worlds here, actually. We've got our world, which is going to hell in a handcart, and you've got the Chinese-led world, which is on the verge of a new industrial revolution. This is why Africa is growing, sort of 10% per annum, whatever, in terms of its GDP. All that investment is going into Africa. Africa is changing very, very rapidly. And you're talking about over a billion souls in Africa. You've got the partnership between China and India, which is building and building and building. We're talking 70% of the world's population rapidly industrializing while we go down the plug hole. That is the future, and that is what is going to determine or continue to provide demand for all raw materials. So, this is, I think, the 20s and into the 30s is going to be the era of commodities. But in addition to that, our currencies are on the verge of a collapse. So what does that do to price? This could accelerate the collapse quite significantly. And we could find that the fiat currency system is over and done with within a couple of years, maybe even sooner. I don't know. We don't know the timing of this, but we can see the factors which are leading up to it.
I know you gotta get out of here, but one last question: with all of these things, investor demand, industrial demand, technological demand. I want to ask you: at what point will we see demand destruction, meaning the permanent or sustained decline in the demand for a certain good, such as precious metals, silver, platinum, in response to persistent high prices or limited supply?
The answer basically is, I've given you the answer with precious metals. Okay. I've also given you the answer for commodities as a whole. We're not pricing them anymore. It's China.
There you go.
Yeah. Now, behind your question, there is the assumption that if you get higher unemployment, then that reduces demand and therefore prices go down. This is a Keynesian rubbish. It's not true. Because these consumers, how do they earn their money if they're not borrowing it? Well, basically, they are employed producing things. They're no longer producing things. So what you see is a decline in demand at the same time as there is a decline in supply. So the idea that the whole situation gets rescued by a recession or a slump, and that will ensure that prices don't fall. This is wrong. It's completely wrong. It goes back to Keynes's general theory, where I think very early on, something like page 25 or something, he tried to rubbish something called Say's law, which basically is, the way he redefined it is that supply creates its own demand. No, that's not quite right. The way to look at it, Say never actually put down his theories into a specific law. It was subsequent economists actually trying to define it in a handy phrase. But the fact of the matter is that if consumers are out of work, then the businesses that provide consumer products equally, they will have sacked the consumers. They will have reduced their consumption. And mass automation basically means that the consumption, if you like, the consequences of people leaving employment could be even higher in terms of cutting off supply. This is a very important point to understand, that Say's law actually does apply. It's not a simple across the board everything, if you like, sort of explanation of why supply falls at the same time as demand. That's not true in many, many cases. When it comes to commodities, demand for commodities, yes, if you get a fall in demand, economic demand generally, then demand for commodities will tend to fall. But as I have said, there's a world out there which is far bigger than us and rapidly industrializing, which will ensure that commodity prices will continue to rise, even without the debasement effect on prices of collapsing fiat currencies. So go back to Say's law, read that one. That's very, very important, and adapt it a bit, okay, for today. But that will, the idea that the fiat currency system is going to be rescued by a recession, come on, it's just nonsense, complete nonsense.
Okay, well said. Alasdair Macleod, I want to thank you for joining us and giving our viewers and investors out there the edge. Can you tell us how they can get more of your insights and information?
Well, simple answer, subscribe to my Substack, which you'll find on MacleodFinance.com. Google it, you'll go there.
All right, appreciate that. All right, thanks again, Alasdair. I know you got to head out, and let's do this again soon.
That's my pleasure. We'll do it. We'll do that. Thanks very much, Patrick.
That was Alasdair Macleod sharing his insights on the economy, the banks, and precious metals. To get more of Alasdair's views, follow him at substack.com @MacleodFinance. And if you want more precious metals insights and would like to know about optimizing your precious metals portfolio, visit us at www.auctusmetals.com. Please do subscribe to our YouTube channel and give this video a thumbs up.